At the end of the accounting period, accountants prepare the accounting ledger for the next period through a process known as the closing process. Closing entries are somewhat like a reset button for the temporary accounts in the accounting system, allowing the business to begin tracking revenue, expenses, and withdrawals for a new accounting period. Think of closing entries like washing the dishes after preparing a meal. You aren't throwing away the pots, pans, or dishes. You are simply cleaning and preparing them for the next use. Similarly, accounts don't delete the information from the revenue, expense, and drawing accounts, and instead they transfer the balances to the owner's equity account and reset the temporary accounts to zero so they are ready for the next accounting period. In many businesses, closing entries are completed automatically by accounting software with the click of a button. However, understanding the process remains important because accountants are responsible for ensuring that the accounting system is functioning correctly and producing accurate financial information. In larger organizations, the closing process can be surprisingly complex. Multinational companies often coordinate the closing process across multiple countries, currencies, and time zones, with portions of the closing process occurring over several days before consolidated financial statements can be prepared. In this video, we'll learn how closing entries are recorded manually, and that will help you see what accounting systems are doing behind the scenes and provide a deeper understanding of one of the final steps in the accounting cycle. Journalizing and posting the closing entries is step 7 in the 9-step accounting cycle and an important step to get the accounting system ready for the next reporting period. The important point to remember is that closing entries zero out temporary accounts in the general ledger, a reset to zero, so that the accountants can report on each accounting period separately rather than commingle the results from one with another accounting period. To use that cooking analogy again, you wouldn't want leftovers from your prior meal on your dishes when you're cooking your next meal. That's why we close the temporary accounts so that these accounts have a zero balance at the end of the accounting period. Just a reminder, temporary accounts include all income statement accounts as well as owner's withdrawals. And there are 4 steps that accountants must take to complete this closing process. In step 1, we'll close all revenue accounts and those income statement accounts that have credit balances to an account called income summary. As part of step 2, we close all expense accounts and those income statement accounts with debit balances to the account income summary. In step 3, we verify that the balance in the income summary account agrees with the net income from the income statement, which tells us that we close all income statement accounts. Then and only then do we close the income summary account to the capital account. And in step 4, we close the owner's withdrawals to the capital account as well. After the closing entries have been posted, the capital account includes the results of operations for the period as well as the drawings. And after this process is done, accountants run a post-closing trial balance to prove out that the entire process was done correctly. To start, we'll of course continue using our textbook example of Eli's Consulting to practice the closing entries. We first identify the temporary accounts, which are the Trade and Eli drawing account for $5,000, fees income $47,000, and salaries expenses $8,000, utilities expenses $650, supplies expenses $500, rent expenses $4,000, and depreciation expense $183. So let's zoom in on that information and prepare the closing entries. Step 1 of the closing process involves closing out all revenue accounts and any other income statement accounts with credit balances to income summary. In our example here, there's only one revenue account and we don't have any other credit balances. So let's close out the fees income account, which has a credit balance of $47,000 by debiting fees income and crediting income summary. For the posting process, we look at the account fees income first and write the date into the date column, the word closing into the description column, the journal page J4 into the post ref column, and $47,000 into the debit column. We now need to calculate the new balance, which is 0. Next, we need to post the credit side of our journal entry, which we'll record in the account income summary. We'll write the date into the date column, the word closing into the description column, J4 in the post ref column, and $47,000 into the credit column and calculate the new balance in this account, which is $47,000. We update the journal entry to show the account number 401 for the fees income account and account number 309 for the income summary account so that it is apparent that the entry was posted. After this entry is posted, the revenue account is 0 and the income summary account shows a credit balance of $47,000. Step 2 of the closing process consists of closing all expense accounts and those accounts with a debit balance to income summary. Expense accounts have normal debit balances. That means we have to credit these accounts to set them to 0. And we do that by debiting income summary for the total of all expenses of $13,333 and crediting each expense account individually. Salaries expense $8,000, utilities expense $650, supplies expenses $500, rent expense $4,000, and depreciation expense equipment $183. We start the posting process with the account income summary and write the date into the date column, closing into the description column, the post ref J4 into the posting reference column, and $13,333 into the debit column. The new balance is $33,667. This amount serves as the first double check that you closed all income statement accounts. The balance in this account should be equal to the profit on the worksheet income statement. The second double check is when we prepare post-closing trial balance later in this video. Next, we need to post the credit side of our journal entry, which we'll first record to the account salaries expense. Write the date, the word closing, the post ref J4, and $8,000 into the credit column, and the new balance is 0. We now need to record the remainder of the credits. The next account is utilities expense. We'll write the date, the word closing, post ref J4, and $650 into the credit column. We now need to calculate the new balance in this account, which is 0. The next account is supplies expense. Write the date into the date column, closing into the description, J4, into the post ref column, $500 credit, and the new balance is 0. The next account is rent expense. We'll write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $4,000 into the credit column. We now need to calculate the new balance in this account, which is 0. The last account is depreciation expense. We'll write the date, the word closing, the post ref J4 into the credit column, $183 into the credit column, and the new balance is 0. We update the journal entry to show the account number 309 for the income summary account and the account numbers 511, 514, 517, 520, and 523 for the expense accounts. After the second entry is posted, the expense account balances have been transferred to the income summary account, and the income summary account shows $33,667, which is the same amount we had on our income statement. So that's our sign that we've transferred all income statement accounts correctly to the income summary account. For the third closing entry, we confirm that the income summary account matches the net income from the worksheet of $33,667, which it does. It's easy, though, to make a mistake, and this is just another checkpoint to say, hey, are you sure you closed all of the income statement accounts? In our case, since it matches, we can now transfer the income summary balance of 33,667 to the capital account. And we do that by debiting the income summary account for 33,667 and crediting Trayton Eli Capital. To post the third closing entry, we first look at the account income summary and write the date into the date column, the word closing into the description column, the post-ref J4 in the post-ref reference column, and 33,667 into the debit column. We now need to calculate the new balance in this account, which is 0. Next, we need to post the credit side of our journal entry to Trayton Eli Capital. We'll write the date into the date column, the word closing into the description column, the post-ref J4 into the posting reference column, and 33,667 into the credit column. We now calculate the new balance in this account, which is 133,667. We now update the journal entry to show the account number 309 for the income summary account and the account 301 for the Trayton Eli Capital account. After this third entry is posted, the income summary account balance is 0, and the balance of the Trayton Eli Capital account is 133,667, and there is only one more closing entry that we need to record and post. Our last step is to close the last temporary account for Trayton Eli Drawing to the capital account. In our fourth journal entry, we debit Trayton Eli Capital for $5,000 and credit Trayton Eli Drawing for $5,000. Post this entry, let's look at the account Trayton Eli Capital first, and as we've done before, enter the date, the word closing, the post-ref J4, and then the amount of $5,000 into the debit column. The new balance in this account is $128,667. Next, we need to post the credit side of our journal entry to Trayton Eli Drawing. We'll write the date, the word closing, the post-ref J4, and $5,000 into the credit column, and the new balance is 0. We update the journal entry to show the account number 301 for the Trayton Eli Capital account and the account 302 for the Trayton Eli Drawing account. After this fourth entry is posted, all temporary accounts should be closed. Accountants double-check that all temporary accounts are indeed closed with the next step in the accounting cycle. The eighth step in the accounting cycle is the preparation of the post-closing trial balance. This trial balance contains only permanent accounts because all temporary accounts, revenues, expenses, and drawings were closed at the end of the accounting period. The purpose of the post-closing trial balance is to verify two things. First, that total debits still equal total credits, and second, that all temporary accounts have been reset to 0. Think of it as one final checkpoint before beginning the next accounting period. At first glance, this may seem like an unnecessary step, especially since most accounting systems prepare it automatically. However, accounting relies heavily on checks and balances because mistakes happen. If the post-closing trial balance does not balance, an error has occurred and must be investigated before moving forward. Even in automated environments, understanding this process is important. Accounting software is only as accurate as it's set up and the data entered into it. I've seen situations where an expense account was accidentally set up as an asset account, causing errors that were only discovered during the review process. And that's why accountants need to understand what the system is supposed to do, not just how to use the software. Now let's take a look at what the post-closing trial balance looks like. This is the post-closing trial balance for Eli's Consulting Services, which is shown on the first line of the header section. The second line contains the title, Post-Closing Trial Balance, and the third header line contains the date, December 31st. Next, we list all asset accounts. and their balances in the appropriate column. And remember that accumulated depreciation is a contra asset account with a credit balance. Next, we list all liability accounts followed by the capital account, and we then add up all the debits and the credits, and both should equal. If your total debits do not equal your total credits, first calculate the variance, meaning the difference between the total debits and the total credits. Does that amount seem familiar? Did you forget to list one of the balance sheet accounts? If that's not the case, divide the amount by 2 because perhaps you entered the amount on the wrong side, meaning a debit as a credit or vice versa. If that's not the case either, divide the difference by 9 to check if you transposed a number, meaning you entered, for instance, 540 instead of 450. If you still can't find it, go back to the last trial balance, and double check each account that you listed in the post-closing trial balance. With time, you will develop a sixth sense for where you made a mistake. A good approach is to work slowly and double check your work along the way. This way, you won't have to spend a ton of time finding your errors. In this chapter, you learned how accountants record and post the closing entries and then prepare a post-closing trial balance. While modern accounting software performs this process automatically, understanding the purpose of the post-closing trial balance helps you appreciate the checks and balances built into the accounting cycle. Every step in the cycle is designed to help ensure that financial information is complete, accurate, and reliable. With the accounting records now closed and verified, the business is ready to move to the 9th step in the accounting cycle, which is interpret financial information.